Right, good morning everybody. Thank you very much for joining us. My name is Jenny Jones. I'm the Managing Director here at Dragon Argent, and this morning I'm joined by one of my colleagues, Sanjay, and we are going to talk all about inheritance tax. So just before we get into the details, a few introductions and a bit of context, I guess. Dragon Argent, I know that we're joined by a few of our clients who will know us well. We're joined by a really interesting group of businesses as well. So thank you all for coming. And we've got between you, I think I looked at the attendee list before, we've got an amazing mixture of, we've got some retail, we've got some tech businesses, we've got, I think, a vegan, very fancy looking handbags. We've got bakeries, we've got all sorts of different things. So it's really good to see you all this morning. At Dragon Argent, what we do is we're a boutique professional services firm. We were founded over 20 years ago. Our founder, James, identified that there were a bit of frustrations with some business owners about how traditional professional services works. He found that they perhaps weren't as kind of comprehensive and collaborative and commercial as they could have been. So really, he's dedicated his career to build this business. We have a team here of 25 people. We support SMEs and scaling businesses with really an end-to-end process as they grow. So we have lawyers, accountants, advisors and tax specialists who help our clients with whatever problems they have as they grow. So one of the things that we do is we have these webinars every month where we talk with one of our experts in a very relaxed way to kind of break down and explain some of these areas which matter to our clients. So that's a bit about Dragon Argent. I'll pass over, Sanjay, for you to introduce yourself, and then I'll come back and do a few more housekeeping-y things before we actually jump into the topic.
Yeah, thank you, Jane. Yeah, my name is Sanjay. I started my career in tax in 2014 at PwC. So I worked in the global mobility space. So that was basically helping clients and individuals either move to the UK or leave the UK. So very much tax planning, filling out tax returns, doing like advisory services on like what decisions should be made, what's the cost of each impact, and sort of helping companies be sort of tax efficient with their strategies. So that was very specialized in sort of companies coming to and from the UK. And then sort of 6 years after that, I kind of moved into more of a pure private client space. So that was more just helping individuals and helping businesses in the UK mainly just be very tax efficient. So setting them up with like special purpose vehicles or like restructuring their companies to make sure they're eligible for all the reliefs. Obviously, some companies were looking to sell, so we're making sure that they would meet all the relevant like reliefs in that area. What the tax position was, so they would know how much they'd have to actually get at the end of the day. And a lot of it was just really a lot of planning. So that's kind of where I kind of came into Dragon Argent. It's basically help a lot of our clients sort of plan stuff and set things up in the correct way, either at the start or once they've already set up, like move it into the correct structure. And a big part of that planning is inheritance tax exposure. So obviously, inheritance tax is quite significant. So it's a tax at 40%. So it's not small. It's not like income tax where you can be quite low. It can be 40% is very high, especially on assets like property or businesses, and it doesn't really add up.
Yeah.
So as long as good tax planning can be done, you can look to reduce inheritance tax. But if nothing is done, it can be very expensive at the end of the day.
So Sanjay joined us a while ago because one of the things that we really believe is that actually, for business owners, that there is it's very difficult and in fact really impossible to separate like a business owner from their personal circumstances as well. The webinar will be recorded, so you can watch it afterwards and share it with anybody else that you think it would find it useful. And please ask us any questions as we go. Sanjay and I have now done a few webinars on different areas in tax, and it can get quite kind of heavy and quite overwhelming. So one of the ways that we'll do that to try and just make sure that you leave clear is actually by stopping at various points and just giving you a chance to ask questions. So please feel free to just do that as and when anything crops up, and we'll answer them as best we can. So without any further ado, inheritance tax. Let's just start imagining that I am one of our clients. So what is it?
What is inheritance tax?
What is it?
So in general, it's really a tax you pay on when you pass away. You have an estate, you have things that you own. You've obviously generated wealth throughout your lifetime, cars, houses, cash, stock, shares, business shares, everything. So you kind of own things, and those all have a total value to them.
Yeah.
And basically the government want to tax you on leaving those assets to your future generation. And that's what inheritance tax is. So it's very much a tax on your estate, on your wealth. It's effectively a wealth tax, but only when you pass away. You can technically pay it when you're alive, but generally it only applies when you pass away.
Okay, so it's the total value of, so it's tax on the total value of the assets that you have gathered over the course of your life.
Everything you've made, all the money you've made, everything you own at the end before you pass away, that's effectively what it's paid upon.
Okay, so if I was to think about, what are the key things that I need to know about this tax?
Yeah, so in the UK, so the government have said that 6% of estates only pay inheritance tax. 6% of estates. Okay. That's not always like the case. Like, it's a very clever way for them to say it. So in the UK, everyone gets rate bands. So effectively, obviously, you know, when you pay income tax, you have a personal allowance, like a tax-free amount.
Yeah.
They have the same thing with inheritance tax. So it's called a nil rate band.
Okay.
So effectively, the first £325,000 of your individual estate is considered tax-free.
Okay.
That's a nil rate band.
325.
Yeah. So the first £325,000 is considered tax-free. In addition to that, there's the residence nil rate band.
Yeah.
Which basically is £175,000, and you get this if your net estate, so the total value of your estate, so the stock, the cars and the houses you own, minus any debts, so like mortgages, if that's below £2 million, and you're leaving a property to your direct descendants, so your children, grandchildren, and great grandchildren, as long as both those conditions are met, you also get the residence nil rate band, and that's £175,000.
Okay.
So the majority of people will probably get a tax-free inheritance tax allowance of £500,000.
Yeah.
And obviously most people are married,
so
they're with a partner. So therefore, and these allowances can transfer over to your partner. So the most common approach in the UK is sort of mirrored wills. So effectively, when one partner passes away, they generally leave everything to their surviving spouse. Yeah. So they don't give anything to the children, everything goes over. You also pass these rate bands over to your surviving spouse.
Okay.
So the majority of cases is that a couple together will have £1 million that they can leave to their children tax-free. That's generally how it works. Why I say the 6% doesn't really always work, because at the end of the day, if you leave something to your spouse, you never paid any inheritance tax. There is no inheritance tax due when you leave something to your surviving spouse. So that 6% factors that in. So somebody could have a net estate worth £10 million.
Yeah.
If they leave everything to their surviving spouse, there's no inheritance tax to pay, and therefore that doesn't factor into that percentage of people paying inheritance tax.
But then when the surviving spouse...
Yes.
But then the inheritance tax will be due
when they pass away.
And they
pass it to their children.
And okay.
Yes.
So it would be payable at some point.
Yeah, it's always payable. It's always,
but it'd be later down the line.
So yeah, exactly right.
Okay, so there are bands, like bands of, and there are allowances. So there's 325, then there's 175 for the residents. You can, as a pair, if you have a partner, you can join them together, which makes 500 each.
Yeah.
Total, $1 million.
So the first £1 million is obviously not in all conditions, but in general, the first £1 million can be tax free.
Yeah.
As a couple, and then everything above that amount is subject to tax at 40%. So it's obviously very high.
Yeah. Okay, so one of the things, so that explains kind of what it is. Why are we here today talking about this? Because there's some changes that are happening, which has led us to want to kind of explain it.
Yeah, so the changes really impact business owners. So obviously on the news, you obviously maybe heard about, the farmers protesting. They had a big complaint about it. That same, the government changed the relief for farmers. But that same relief applies to business owners. It's slightly different, but effectively it's the same thing. So originally, the relief is called business property relief.
Yeah.
So effectively, business owners previously could leave all their shares in their companies to their children in their will, and there would be no tax implications. So there wasn't really a huge need to do any tax planning. You could basically write in your will that your shares go over to your surviving spouse. Just when your surviving spouse passes away, the shares go down to your children.
Yeah.
If you have a £10 million business, there's no tax implications. That continues to run. Your children take over.
Yeah.
No issues at all.
Yeah.
What the government have now changed is that business property relief is now limited to £1 million. So each individual, I just mentioned the rate bands. Everyone gets a rate.
Yeah.
Everyone now gets a business property relief rate band of £1 million.
Okay.
So you can now leave £1 million of business property or your company to your children tax free, and everything above that amount is subject to tax at 20%. So it's less, but it's still subject. So some people will have significant value in their business, and they will want to leave that to their children in their will. This could have a significant impact because once you pass away, that company may not be able to run because it's effectively in probate. No one owns the company anymore because until you pay the tax, you don't really own it.
And what are the timelines for, obviously there's the autumn budget coming up, but this is coming into effect next year, isn't it?
So the business property relief rate band comes in from April 2026.
Yeah.
So if somebody passes away now, they wouldn't have this issue, but obviously April 2026 isn't that far away.
Yeah.
So this is something that everyone's going to have to plan for.
Okay, so we are going to talk a little bit more about what business property relief is and how it works in practice. But before we do, I'm just going to see if anybody's got any questions so far. Okay, does spouse include a civil partnership?
Yes.
Yes. Okay, so and actually does do direct. So it does include a civil partnership. Does it include any other form of partnerships that are not official?
No, it has to be official.
It has to be official. Okay. And what about direct descendants? Can that be stepchildren?
I believe stepchildren would count. Yes.
Okay, stepchildren, as long as the marriage at the top was the partnership at the top was official.
Yeah.
Okay. Thank you, Steve, for that question. Let me just see if there's any other. Got some in the chat. Let's have a look. Okay, so who or what organisation is it charged by?
It's like a government tax. HMRC imposed a tax on individuals. So it's only individuals that pay inheritance tax. So businesses don't pay it, but obviously your estate is made up of your business by the shares you own. So therefore it's due on you as an individual. Okay,
so it's HMRC that sends the bills. Right, so hang on, no, let's just see if that. Oh no, that's fine. I answered that question. This is the joys of answering the questions and doing the webinar at the same time. So bear with me sometimes. Okay, so the big change. So we've said then April 26 is when this changes. What can you just explain how it works in practice for business owners? This business property relief.
Yeah. So.
Is there anything else that you haven't covered?
So there are certain conditions that have to be met. The main one being you have to own a certain percentage in the company.
Okay.
It has to be a trading company that's non-quoted. So effectively, it can't be a big company on the stock exchange. Okay. So it has to be a privately owned company.
Privately owned, okay.
You generally have to own a certain percentage of the shares.
What sort of percentage is it?
I think it's 5%, but I will double check that point.
Okay.
And you also need to own the shares for at least 2 years.
Okay.
So you can't just, if you know something's about to happen or you think you might be some people may have conditions where they might pass away soon. They can't just set up a company, put loads of money in it, and it's considered a trading company, and they get the relief. You have to own the shares for at least 2 years. So
okay. So if there are people on the call today who have got businesses who do meet all of those different criteria, is there anything that they need to? I mean, what do they do?
There are certain things to worry about. For example, when I mentioned business property relief, it only applies to trading companies.
Okay.
And there's a quite clear distinction on what a trading company is and what it isn't.
Okay.
So companies that invest in sort of properties or stocks and shares, they're called investment companies.
Okay.
And they're not subject to business property relief.
Okay, so investment companies. So anything that is. So for example, say you buy a property to rent out.
through a company.
Yeah.
That's an investment company. That's
Okay.
not a trading company. Even though you're technically trading, you're doing rental.
Yeah.
That's your trade.
Yeah.
But the main value of the company is from the investment it owns.
Okay.
Therefore, it's considered an investment company, and it doesn't come with its relief. A common mistake a lot of companies have is they will have the trading arm of their company in one trading element of their trade in one company,
Yeah.
and they will have like the property or the warehouse in another company.
Okay.
If they're considered separate companies that they own separately,
yeah,
that company that is the warehouse or is the office or something like that,
yeah,
that's considered an investment company, because technically speaking, that's leasing the office space to the other trading company.
Because even though they do separate things, they're part of the same group structure.
So if they're not connected, so
Yeah.
if you just own one company, both
Yeah.
companies individually,
Yeah.
like not connected, then technically speaking, one company is an investment company and one company is a trading company.
Oh,
And
right.
therefore, the investment company doesn't get the business property relief. You can restructure these companies to
Yeah.
put them into the same group,
Yeah.
and therefore it becomes a trading group,
Yeah.
and then the whole group would get relief.
Okay, so can you have a trading group of investment companies?
No.
No.
No. So if all the companies just investment stuff,
Yeah.
then it's just an investment group.
Okay.
But if you have like an office that you own just in one company,
Yeah.
and it's not connected, that would be considered an investment company. If you put it into a group structure where you use the office, then
Yeah.
it's a trading group.
Okay, so there's lots of things. So so the business property relief is not something which every single business owner gets.
No.
You need to be aware of exactly what qualifies and what doesn't.
Yes, and then another nuance point is a trading company there's no correct definition of a trading company, but it's generally seen as long as like 80% of like the value of the company or the time spent on it is through trading elements.
Yeah.
So another like common mistake is people open up consultancy companies.
Yeah.
And at the start they're all trading companies because you're doing consultancy work.
Yeah.
But over your lifetime, you may generate quite a lot of funds which you haven't extracted from the company.
Okay.
And by the end of the company, when you've retired and it's got £500,000 sitting in cash in the company,
Yeah.
it's no longer a trading company because the value is now coming from investments and cash.
Oh, I see. So something that starts as a trading company can turn into an investment company if the trading doesn't continue.
Exactly.
Oh gosh. Okay.
So there's lots of different conditions and things that need to be looked out for in this situation.
Okay. Right here, let's have another question. Okay, if a share sale was in progress at the time but not completed, how would that be treated?
So the shares would still be part of your estate for inheritance tax purposes. So if the company was a trading company, then you'd probably get business property relief on the shares that are owned.
Okay.
If it wasn't, then you wouldn't get any tax relief on it. So yeah, they would be part of your estate and subject to inheritance tax.
Okay. I hope that answers your question. Let me see. No more in the chat. So we've talked a bit about. So that's one of the big changes is that business property relief. What are the other ways that people can reduce their inheritance tax exposure?
Yeah. So obviously we've talked about inheritance tax, what it is, when it's paid. Obviously, it's nice to know when it's paid, but no one really wants to pay inheritance tax. It's very expensive.
Yeah.
You really want to reduce it where possible. And so if you think about it this way, inheritance tax is due on your estate.
Yeah.
So how much you own. The best way to reduce how much you pay on what you own is to reduce what you own.
Yeah.
But if you reduce the value of your estate, you will naturally pay less inheritance tax.
Yeah.
There's a number of different ways you can do this. Obviously, one of the main ways is you can look to gift assets and gift things out of your estate.
Yeah.
Obviously, people will have children. They will want the children to be part of the business, or they will want to give them things.
Yeah.
And that can be quite a good way of reducing your inheritance tax exposure.
Yeah.
So
that's the 7 year.
Yeah. So 7-year rule. Yeah, which a lot of people know about the 7-year rule.
Yeah.
It comes up quite a lot. So if you think about it this way, so in the UK, there's no such thing as a gift tax. We don't actually have. A lot of other European countries have a gift tax. So there's a certain amount you can give away, and after that, you either pay tax or you can't give it away.
Okay.
In the UK, we don't have such a thing. So from that sense, if someone owns £100,000 in cash and they want to give it to their children, if they were to give it to them now and they survive for 7 years, there'll be no inheritance tax exposure.
Yeah.
Nothing to pay.
Yeah.
It's completely fine.
Yeah.
There's no limit to that. That can be 100,000. It can be £10 million.
Yeah.
If it's cash, absolutely no issue.
Yeah.
But because we don't have a gift tax, assets are subject to capital gains tax instead.
Yeah.
So that basically means is if you give something away, which is an asset, so shares, a property, things like that, you're paying capital gains tax. So the person who gives them away is effectively selling that property at the current market value. And that basically means they pay capital gains tax upon the uplift. So most properties have gone up in value. So people buy properties very early on, £100,000, worth £1 million now. They want to give it to their children to avoid inheritance tax. Instead, it's subject to capital gains tax when you're alive, and you pay tax on that gain at 24%.
Okay, which is less than 40%.
It's less than 40%, but bear in mind, obviously, you're still subject to the 7-year rule. So technically speaking, you could pay this 24% capital gains tax. You could pass away in the next year. That would fall back into your estate. You'd pay the 40% on top of that, and you wouldn't get the credit for the tax you've already paid. So there is risks with doing it. And also bear in mind that you're paying tax. It's like a dry tax charge. You're receiving no money and you're paying 24%. Not everyone's got that sort of cash to pay the tax on.
No. Okay, so planning, so let's go back to that. I sort of digressed slightly. So that was gifting. So what other things can people do?
So that's gifting. So with property, it's very hard to save inheritance tax. You are generally subject to inheritance tax. There are certain things people can do when they own multiple different properties, and we can talk about in a different area. But if you own 1 or 2 properties, there isn't much you can do from an inheritance tax planning point of view from gifting them. You can't really gift them. You are subject to capital gains tax. If you're happy to pay it, that's what you can do. The other, obviously, a lot of people will own shares in a company. And they are technically capital assets. So if you want to gift those shares to your children, technically you're doing the same thing. You're giving away assets and you're paying capital gains tax on it. However, there are certain reliefs for trading companies. And one of them is called holdover relief, which basically means you get to defer the gain. So instead of you paying the capital gains tax charge on it, your children will receive the shares at their nominal value, so the value you own them at, rather than market value. And that means whenever they sell the company, they'll pay capital gains tax. So that's a very good way of transferring shares from your name to your children's name without paying any tax upon transfer. And again, as long as you survive for 7 years, there's no tax charge.
So you're leaving the kids to pick up the tax bill, but only as and when
they sell the company.
But only as and when the company is when there's money to do.
So it's very good in the sense that you can effectively pass things over to your children very easily. But you bear in mind that you are now giving a probably very wealthy company to your children, which they will own in their own name. You will lose control of that company if you give them shares directly. There are different legal things we can do with the share structuring, with the share rights and that sort of stuff, which we can look into, of like you make the shareholders agreement a bit more complicated, a bit more robust, where you still own some of the shares or you own different rights to the shares to your children. So maybe you pass the equity onto them and you own the voting rights to the shares. But that can be done. So it's from a tax perspective, it's very easy to transfer shares, but from a planning point of view and running the business point of view, it can get quite messy and quite complicated because bear in mind these shares will now be owned directly in their own name. So if something happens to them, so legal proceedings, divorce, things like that will form part of their estate in those sort of methods. And there are risks associated with it. So gifting shares from a tax perspective is very good, but there's other legal risks that come along with it.
Okay, makes sense. Okay, we've got another couple of questions. So, right, Sam, yours is a long one. I'm going to come to yours in a second. So, okay, how is the company valued for business property relief purposes? And does cash sitting in the company, profits not dividended out, count in that value?
They do. You generally just have a company valuation done. So it's basically you just get a company valuation done upon death or whenever you transfer. That's just kind of a common procedure.
Okay. Okay, Steve, I hope that answers your question. Okay, Sam. So thinking of this through the lens of an investor rather than a business founder. So if I invest 10,000 in 10 different companies under EIS, SEIS, previously these investments would have been exempt from inheritance tax by virtue of the business property relief. As I understand it, under the impending rules, each of the investments would need to be valued if the investor dies, and the IHT would be due on the aggregate current value of the shares, even though this is a theoretical valuation in an illiquid asset and represents a dry tax charge over an asset which could fail entirely.
Correct.
Is this summary correct? And if so, how should investors with existing SEIS and EIS investment portfolios manage this risk? In theory, they could gift the shares outside of period B and subject to any transfer restrictions in the investee articles, but
Yes. Yes, that's basically all correct. EIS shares still have business property relief. So obviously, if your investments are below £1 million, you still get the business property relief. But yeah, everything you've said is correct. Obviously, government haven't really announced how the tax charge will work on it. For example, if you leave cash in your estate, inheritance tax is due sort of 6 months after you pass when probate sort of issued.
Yeah.
But when you leave property, like I said, a dry tax charge,
yeah.
it's an asset that you want to keep that you have to pay tax on. They do have payment plans set up so people can pay over the course of 10 years. So that may be something similar to do with shares. So because it's all very new, they haven't really announced how the payments on the tax will work. But in essence, yes, you could effectively have a dry tax charge on shares, which may not have any value in the future. They haven't really announced anything, so there could be maybe relief available for when the EIS shares become worth nothing, if they become worth nothing.
Are we expecting them to announce this level of detail?
You would hope so, yeah. Because they obviously announced the rule changes last autumn budget, and now they're coming in this April. So this is the autumn budget where they should give you more clear guidelines on what's going to happen and how it's all going to work.
Okay, can you explain to me dry tax charge?
So yeah, dry tax charge. So imagine you sell a business.
Yeah.
You pay tax on it.
Yeah.
But you have money coming in on the sale. So therefore you're paying tax on the profit you've made.
Yeah.
You have cash. You've made lots of cash. You're paying, some of it goes away to tax.
Yeah.
If you give something away, you aren't receiving any cash for it. You are just having to pay a tax bill without receiving anything.
Oh, got you. Okay, fine. Okay, makes sense. Thank you. Sam, hope that answers your question. Type away if it doesn't, and we will come back to Sanjay. So let me just see any more questions. Okay, one more. So what are, and please keep these coming because this is exactly the point of this time together. Paul, what are the pros and cons of creating a family trust? Okay, that's interesting.
Yeah.
Because the next two, the two topics that we have got that Sanjay is going to talk about are trusts and wills. So
yeah, so we'll move on to trust and then
we'll come on to that. Yeah, so we'll come on to that, Paul, in a second. Let me just answer. I think there's one. It's confusing. There's some in chat and some in Q&A. So hold on. Let me see. Can I find? No, are they chat? Where? Hold on. Sorry, bear with me one sec. Okay. If the kids, so Vanita, if the kids are not 18 yet, how does it work?
So technically speaking, children can own shares in a company.
Okay.
They can't receive dividends in a company.
Okay.
So it's to do with like share rights and those sort of things. But in general, it's also risky having shares in your children's names below 18 or even at 18 because, like I said, at the end of the day, they will own these shares and you don't know what will happen to them. So, like I said, like from a tax perspective, generally gifting is very good, but we'll move on to trusts, where trusts are generally maybe slightly more expensive from a tax perspective, not by that much, but slightly more. Yeah. But you offer a lot more legal protection around them, so therefore they generally are used a lot more.
Yeah, it's a funny thing. With like a 9 and an 11-year-old, I do kind of wonder whether how good, if we go down this, would they be responsible?
Yeah.
I don't know. I'm not sure. Okay, one question on here. So Vlad, are you familiar with life insurance solutions for protecting against inheritance tax?
Life insurance policies, they are effectively like a trust. So when they're paid out, you don't pay any inheritance tax on the payout of a life insurance policy. So what people will generally do is they will take out life insurance policies equivalent to their inheritance tax liability at the end.
Okay.
So effectively when they pass away, the life insurance policy will just cover the inheritance tax exposure at the end. It's not really, it's more like you're paying a bit of money now to avoid having to pay the large tax bill at the end.
Okay.
Some people take it out on a temporary basis too.
Yeah.
So, I mentioned the 7-year rule. Yeah. So obviously you could gift a property to somebody.
Yeah.
And pay the 24% capital gains tax charge, and then take out a life insurance policy for 7 years to cover yourself on the gift, so to avoid if something happens.
Okay, makes sense. Okay, we've got another one here, another question here. This is the last one I'm going to answer. I'm going to ask you now. Then we're going to do the trust. We're going to do trusts and wills, and then we'll come back and do some more Q&A. This is from Montesir. So is an unincorporated partnership eligible for BPR?
Yes.
And if one of the partner is elderly and wants to gift away his 50% share to the other partner, what would be the best course of action? Presumably, have a chat with you to work out some planning.
There can be tax implications of gifting your share in a partnership, and a part of it will depend on what the partnership is.
Yeah.
So there are definitely things that can be done, and the alternative is, obviously, if the partnership is eligible for BPR, maybe nothing has to be done, depending on the level of value it is. So, like I said, part of inheritance tax planning is looking at everything together as a collective.
Yeah.
And sometimes the advice is to do nothing, because at the end of the day, I mentioned about properties.
Yeah.
So, for example, when a property passes through inheritance tax, through probate, it gets uplifted to the current market value.
Okay.
So if somebody's net estate is worth, say, £400,000, and it's made up of one property, and that property was bought at, say, like £100,000, it's now worth £400,000.
Mm-hmm.
If they were to gift it or sell it when they're alive, they pay the tax on the uplift.
Yeah.
But when you pass through probate, the person who receives it at £400,000. So they could then sell it, and they pay no capital gains tax on the sale, because they're receiving it and selling it at the same value.
Okay.
So sometimes tax planning of inheritance tax is actually to do nothing, because things passing through inheritance tax and through probate actually is beneficial.
Okay, makes sense. So, Muntasir, I hope that answers your question. Trusts. Talk to me about trusts.
Yeah. So
what are they? Why are they good, or are they good?
Yeah. So people have heard about trust, or people mention trust, and they sound super complicated, and people think there's an immediate way to save inheritance tax. Trust just save you inheritance tax. That isn't always the case. Most people don't know this, but you can pay lifetime inheritance tax. So effectively, you can pay inheritance tax when you're alive.
Okay.
And that works with trust. So if you move something into a trust, technically speaking, you can pay lifetime inheritance tax on that at 20%. I mentioned that everyone gets a nil rate band.
Yeah.
That also applies to trusts. So effectively, if you put something into a trust that's worth more than your nil rate band, so above £325,000, so say you put a property in there, technically speaking, you will pay lifetime inheritance tax on that transfer. So say it's worth £500,000, your nil rate band is £325,000, so you'll pay for 20% tax on the £175,000 difference.
Okay.
So that's what trusts are. So when somebody says use a trust, it will save you inheritance tax. It can do, but it doesn't always. There's not some nuances that go along with trusts. But what a trust is, it's effectively almost like a separate legal entity that sits outside of your estate.
Mm-hmm.
So say your estate's made up of like £5 million, and you want to transfer something into a trust. So you transfer £1 million of your shares into a trust. Technically, your estate is now worth £4 million, and the trust estate is worth £1 million.
So completely separate. Completely separate.
Yes, they're effectively a separate legal entity.
And what is the lifetime inheritance trust then, in the inheritance tax? How does that work in practice? Is that something you can only get if it's part of it, only get through a trust?
So you'd only pay lifetime inheritance tax if you put something into a trust.
Oh, I see. Yeah. Okay, so it's only for trust.
Part of the planning around trust is making sure you avoid the lifetime inheritance tax, because once you factor in the 20% and additional charges on top of that, you're getting close to your 40% by the end of it. So it's not that beneficial by the end of it. So trust can be really useful, but it's making sure you use them in the right way. So for business owners, they're especially beneficial because, I mentioned business property relief.
Yeah.
So business property relief also applies to trusts.
Yeah.
So instead of gifting your shares directly to your children, why don't you put them into a trust where the trust owns them?
Yeah.
You are the trustees, so you control what the trust does.
Yeah.
And your children are the beneficiaries of the trust.
Yeah.
So, and then business property relief also applies here. So originally, obviously, there was no cap on it. So people could put their £10 million trading company shares into a trust, and there'd be no tax. And it will just run normally. There's no issues.
Okay.
Now there's going to be that £1 million limit, but again, it comes in from April 2026. So people can now, if you have a big trading company, you could move that into a trust right now, and there wouldn't be any lifetime inheritance tax to pay. If you do it after April 2026, anything above £1 million would pay tax on that input.
Okay, so now, and that goes back to the reason why we're having this webinar in the first place, which is that the rules are changing in April, but there is still plenty of time to act now in advance.
Yeah, so I would say treat trust as another way to gift shares in your company or gift things to your children, without giving it to them directly. It's effectively putting them somewhere separate, where it's a discretionary trust, so it's up to your discretion when they receive them. But effectively, you can move things outside of your estate, save inheritance tax, without putting them directly into your children's name and protecting it from a legal aspect too.
Okay, so hopefully, Paul, hopefully that answers your question about the pros and cons of trusts. The other thing was hang on, we've got one more now. Well, want to do wills first, and then we'll come and answer this question.
Yeah, sure. Yeah.
Okay, so because that was the last thing. The wills are slightly some action is required.
Yeah. So obviously, the first point is everyone should make sure they have a will set up. So obviously, if the will isn't set up, the government, there's like an automatic provision of like where the assets go, and it doesn't always go the way you think it will go.
Yep.
And so it's obviously just important to have a will to start with. But a lot of wills most people have in place currently are mirrored wills, which basically means that all my estate will go to my surviving spouse if I pass away first, and then they will get divvied out to your children as when you see fit, how percentages you want. The issue with the government changes is the business property relief or rate band that I mentioned.
Yeah.
So I mentioned the nil rate band and the residence nil rate band. Yeah. They transfer over. So you pass away and you don't give away anything. You only give it to your surviving spouse.
Yeah.
You haven't used any of your rate band.
Yeah.
Therefore, it moves all over to.
So the whole 500 goes over. Yeah.
The business property relief rate band doesn't move over. It's a use it or lose it situation.
Oh, right.
So that basically means for mirror wills, they don't work anymore, because if you have business property assets, if you transfer them all over to your surviving spouse, they will only get £1 million allowance themselves. They won't get the £2 million allowance.
Oh, I see. Okay.
So basically, you want to have wills which transfers business property relief eligible assets to your children now, up to £1 million, and the rest goes over to your surviving spouse.
Sorry for the noise in the background. This is the joys of being based in the middle of London. There seems to be a lorry very noisily reversing right outside the window. So hopefully you can all still hear. Will hopefully finished its journey shortly. Okay, so they were mirrored. Now that doesn't work. So can you just repeat? I was a bit distracted when you asked that. What was the last bit of what you just said?
Yes, it's because the allowance is a use it or lose it allowance. You want to make sure that in your will you kind of state that the first £1 million of your business property assets, eligible assets, are transferred to your children.
Okay.
And then obviously part of that's doing your will. Yeah. Part of that is maybe restructuring your company, because at the end of the day, if you're going to be giving shares in your company to your children, do you really want to be giving them the voting right shares straight away? Maybe you want to be giving them non-voting right shares or equity right shares. So part of it is restructuring your company slightly to have a different class of shares. Yeah. And part of it is just changing your will to make sure that you use your allowances now.
Okay, because if you don't, then you lose it.
Yeah, exactly.
Okay, so let's go back to we've covered a lot of things so far. There's a couple more questions here. So Satinder, how do you protect your children in a situation in the event of a divorce? So you don't want the future partner taking your child's inheritance.
Yeah, and that's basically where trusts come in.
Okay.
So like you said, the trust sits outside of your estate, but it also sits outside of your children's estate. So upon a divorce, that's not factored in, because that's not part of their estate. They don't own it.
So in this instance, then it would be completely separate. It would still be owned by. It would still be run. The trustees would still be whoever set it up originally. Yes. The children would still. There'd be no risk to the children getting what is in it for them through any sort of change of their parents' marital status.
Yes. So like, if your children gets divorced, when they look at like the assets the children own, the stuff that's in the trust won't be factored in.
Oh, so that's when the children get divorced.
Yes,
but if the parents, so
normally the risk is when you give something to your children,
you're
always slightly worried what happens if they meet somebody wrong and they get a divorce and they lose half the company, or they lose loads of money.
Okay. Yeah. Oh, I was thinking about this more from if the parents. So there's two different. I mean, but the answer is still the same.
Yeah.
So if the parents get divorced, and when the parents were together, they'd left something they'd set up a trust for the child.
Yeah, that's still
one parent then goes meet somebody else. Yeah. This new person, the wicked stepmother, let's call her for the sake of this, can't come in and steal anything.
No,
because it's completely separate. Yeah. Okay, fine. And then the same would happen if that said child grows up, gets divorced, then everything stays in their name.
So it stays in the trust name.
Stays in the trust name.
Trust is separate. Yeah.
Okay. So it still wouldn't be part of their estate, exactly. As and when and if they got divorced.
Exactly right.
Okay. Sorry, I was a bit round up. Took me a minute to get my head around that one. Okay, so we don't have any more questions. I don't think at the moment. Oh, hang on, let me see. Oh, yes, we do. Hold on. Is it possible to reassign tax rebates?
I'm not sure what that means.
Okay, so to regain them. So I guess if you lose it, can you get it back? No.
Tax rebates, but
So maybe I'm not sure. I don't know. Jeffrey, would you mind just clarifying that question, please? So claiming tax rebates. So that's kind of what we've talked about. Is that the structuring? How can you structure things accordingly?
Yeah. So for example, if you lose the conditions to meet certain reliefs, you can regain them.
Yeah.
But yeah, that's the question. Yeah, you can. If you don't have the ownership period at the start, or you don't meet some conditions at the start, you need to meet the condition over a 2-year period upon the transfer.
Yeah.
So yeah, that can happen. So you can regain the conditions.
Fine, that makes sense if you set things up and they're eligible in the right way. Yeah. Okay, that makes sense. Okay, is there anything else that we haven't talked about that you think is really important to cover?
It's mainly just that, there's lots of different ideas and lots of different ways you can save inheritance tax, and it's not one size fits all.
Yeah.
What you want to do is you want to do a full review of your estate. Like, how much do you own? What do you own in your own name? Like, what's part of your business? What gets relief? What doesn't get relief?
Yeah.
Work out what your estimated liability is now with no planning.
Yeah.
And then come up with 4 or 5 different ideas on what you can do, and then you pick the one that suits you the best.
Yeah.
Like, trust may work for certain people, but gifting may work for certain people.
Yeah.
And it's, what do you gift? How much do you gift?
Yeah.
When do you gift it?
Yeah.
What do you want to do with your cash? What do you want to do with your stocks and shares, ISAs?
Yeah.
All those sort of things. Do you want to invest in EIS shares to qualify for business property relief? What's your risk on, are you worried that you might pass away within 7 years? Do you want to invest your cash in some business property relief eligible assets?
Yeah.
And therefore the relief is only 2 years rather than 7 years.
Yeah.
So there's so many different things you can do. It's deciding which ones you do and how much risk you have, and it's basically picking the right. You can do a mix of different things, and it's picking the right one for you and how much you want to do on each one.
Yeah. Okay. That makes complete sense. And I think we will. I mean, after the call, the recording. So the webinar has been recorded. The video will be shared, so you can watch it again. I'm always conscious when we do these that there is a lot to get through. And I think there will be a transcript of the video as well, which will help you kind of flick through to the bits that you're most interested in. Also, we'll share. Obviously, Sanjay is around and very happy to talk to anybody about anything further. So we'll share details of your calendar, and you can please feel free to set something up with Sanjay to talk about anything specific. But if there's nothing else that people are asking, I think then we've covered all the things. I think. So thank you very much for everybody for joining us. I hope you have left with some useful tips and feeling a bit more confident about some of the specifics. I mean, as the next webinar that we're going to be doing will be at the end of November, so the 28th of November. That will be after the autumn budget, because that's going to be on the 26th. As we talked about briefly here, it is possible, it is hopeful that the government might give some more information about some of the things that we've talked about. So we will certainly be watching that closely. So please feel free to come back and join us on that one. That webinar will be with myself and Sanjay, but it will also be with Harry Hasler, who's our head of accounts. Harry is the outsourced financial director for lots of our clients, so brings a kind of different and a wider perspective to some of those things. So yeah, please feel free to come and join us back then. We'll see if the government gives us the answers to some of the questions that you've been asking us today. But thank you all. Happy rest of Thursdays.
Yes.
Thursday, yes. And hope to speak to you at some point soon. Thanks very much all. Bye-bye.